Consider the ultimate financial goal, retiring early and paying all your bills with passive, recurring income from long-term dividends. You buy the stock once, and the checks arrive like clockwork. But the modern market is punishing that strategy. Decades-old household name corporations are suddenly slashing their payouts, leaving income investors stranded. Take AT&T. For years, it was a cornerstone of retirement portfolios. Then, in 2022, the company cut its dividend by 47%, instantly wiping out nearly half the cash flow for investors who depended on it. The following year, Intel followed suit. The tech giant slashed its payout by 66%, evaporating decades of reliable income for its longtime holders. These investors face a severe double whammy. They lose their monthly cash flow, and because a cut signals deep financial distress, the underlying stock price usually plummets right alongside it. In both cases, investors ignored the mounting corporate debt because they were fixated on the size of the check. This selective blindness is a psychological glitch known as the focusing illusion. The focusing illusion is a mental shortcut. When the brain is forced to navigate complex data, it often simplifies the problem by fixating on a single salient metric and ignoring the rest. In finance, this manifests as an obsession with the dividend yield. We look at a glowing percentage, and it blinds us to debt, declining market share, and negative cash flow. This psychological glitch drives the popularity of traditional monthly covered call ETFs, which attract billions of dollars by promising high income and downside protection. This line graph maps the mechanical flaw of those traditional funds. In exchange for a short-term monthly premium, investors accept a hard horizontal ceiling on their long-term growth. Meanwhile, their exposure to market crashes remains wide open. The real-world data proves the danger. During the 2020 market crash, monthly covered call funds absorbed 88% of the S&P 500's drop. But when the market bounced back, they recovered barely half the lost ground. By staring exclusively at the monthly income check, investors were blinded to the asset's structural asymmetry, trading away essential total return for a false sense of security. We see the exact same illusion when people pick individual stocks. Look at Walgreens. Entering 2024, the stock boasted a nearly 50-year history of consecutive payouts and a massive 9% dividend yield. For income seekers, those two numbers were irresistible. But that shiny facade hid a terminal disease. A brutally competitive retail environment and expensive international acquisitions were systematically destroying the company's economic moat. This bar chart compares Walgreens' actual earnings to the dividend they were paying out. The payout bar is nearly 3 times larger. They had a staggering 290% payout ratio. A 290% ratio means the company was paying out nearly $3 for every dollar it earned. They were draining their cash reserves and operating with negative free cash flow just to keep up appearances. The inevitable collapse arrived in January 2024. The dividend was drastically slashed to 25 cents, and the stock's overall value plummeted 60% over the year. Investors who stared exclusively at the legendary history and the 9% yield completely missed the terminal financial decay happening right in front of them. Escaping the focusing illusion requires a mindset shift. You have to stop isolating the yield and start evaluating your total return. To do that, income investors use a diagnostic checklist. This forces the brain to integrate multiple data points before making a purchase. Rule 1, verify the payout ratio. A sustainable dividend requires a ratio safely below 75%, and that payout must be backed by actual free cash flow, not just accounting earnings. Rule 2, demand a strong economic moat and a manageable debt-to-equity ratio. If a company can survive an economic shock without borrowing money to pay you, the dividend is secure. Rule 3, diversify your income strategies. Instead of relying on a few high-yield stocks, instead consider splitting your income streams using daily option ETFs or dividend growth funds that automatically reinvest your payouts. A massive dividend yield is rarely a gift to be celebrated. More often than not, it is a loud warning siren demanding extreme caution. Mastering the focusing illusion stops you from staring blindly at the shiny numbers, giving you the clarity you need to evaluate the true long-term health of the ship.